gentlemen, our only request for the lovely audience is to speak loud and clear into these microphones and pull them towards you so that we can hear all your wonderful investment advice. So I wanted to really set the scene to start with, because obviously lots of different perspectives here about the current state of the asset allocation landscape. And since you're next to me, Dan, give us your view of 2025 and beyond. So we can look to next year, but also look beyond that in terms of the investment landscape and asset allocation.
Sure. I think to start, I think we're a long-term investor, so we don't tend to really have a one-year outlook. We always use our asset allocation process to actually have a much more longer view. But what we've seen ultimately is that the external environment is definitely changing. Market opportunities are becoming very thin. There is fewer market inefficiencies. Opportunity windows are very narrow. So what we've done internally is adapting ourselves to become much more agile, to be able to actually capture these opportunities in a most efficient way. So one way to actually look at it is definitely focus on the top-down, long-term perspective, but having the ability to structure ourselves to become much more agile to capture these opportunities in a much more faster way. Traditional asset classes, I mean, we heard this from the previous panel just now, are becoming very blurry. So real estate is becoming closer to infrastructure. Infrastructure is becoming much more closer to private equity. Private credit is everywhere. So we see opportunities where actually where asset classes actually do cut across. And again, you need to be agile and adaptive to be able to capture this.
Yeah, and I think that's a really interesting concept, as you said, that there's this merging. Phil, from your perspective, obviously another long-term investor, of course, but the vagaries of the market in between, what's your perspective?
Well, I think if you look today in terms of the current landscape, I might say feast or famine, in that there's great economic growth, particularly if you look at the US economy, but the level of uncertainty right now and the volatility that could be in front of us, I think there's a range of scenarios. Certainly, as Dean said, the blurring of asset classes lines creates opportunity, but also greater complexity. And when you look at the US economy, it's been so resilient. You now have the opportunity of the expectation anyway of deregulation, of a very accommodative Fed policy in front of us, and that environment is likely to have a robust continuation of growth. At the same time, there's undercurrents that could be unsettling, and whether that is a labor policy with immigration that could be challenging and cause labor to be more costly. Tariffs would be another dynamic. But in this environment, you've also got geopolitical risk. We just look at the region here. There's such a change that has been so dramatic. But I think in this environment, the role of private assets, private credit in particular, and real estate, I think those are arenas that have real potential in the coming years.
And David, if I could bring you in on that as well, your sort of macro picture and a little bit lower the macro in terms of the outlook on this asset allocation.
Yeah. We inhabit a corner of the investment world that makes it very, very hard to react to macro. So our firm is focused just on venture capital and private equity in very long-term and liquid portfolios. So it's really difficult to, in some ways it's comforting because you focus on other things. And so we build these portfolios that really take 5 to 15 years to realize their outcomes. And so it's very hard in a single moment in time to sort of react to next year and make bets on that. That said, we naturally live in the investment world, and our role fits into sort of a broader array of asset classes, and it has a role to play there. So, we're based in California. We're in the thick of the AI trend now, but over the course of these portfolios that we manage, there are typically many trends. On the private equity side, those are more sort of normal businesses, like less tech-oriented, and ideally you're looking for businesses that'll do well through up and down cycles, recognizing that there are up and down cycles.
Luckily, you've been in the right place of the market, so you had a bigger part of the pie, that's for sure. If I come through to you, Shiv, what's your kind of outlook as well?
Sure. Good afternoon, everybody. Our mandate and our objective function is to make double-digit absolute returns, rain or shine. And if you look, and that's what we've been doing. If you look at our returns, about 13% with a beta of 0.2 last year, last 5 years, the asset class that I focus on, which is hedge fund investing, has made double-digit returns net. And so that is kind of how, and that has been consistent throughout. So just to give you a perspective of where I come from, in a year like 2022, we were up around 8.5% when your standard 70-30 was down 18%. So if you look at it on a go-forward basis, asset prices are not necessarily cheap. Now one can sit and debate, I mean, how expensive or inexpensive it is. But clearly, where various assets, public market equities as a case in point is trading, it's certainly not cheap. But then there has been changes in administration, particularly in the US, that I think can be transformative. And the feelers that, the cues that we have got so far, which are somewhat clear, is on the deregulatory front in the US. So that's clearly a theme I think that investors should take advantage of, and we are looking to take advantage of as well. And on the negative side, the uncertainty, as you were talking about, is clearly on the tariffs, how far-reaching it's going to be, and we have to wait and see. So what that tells me is there's going to be more volatility in the markets, but amidst a very constructive backdrop, given particularly the US is in a relatively good spot. So with that said, we continue to see exciting opportunities in spread strategies, long-short strategies, where you can take advantage of good companies, be long them, and short bad companies. And that's been something that I think will continue to persist. And these strategies do well when there's volatility. And just by way of themes, to take advantage of the policy backdrop, the 3 or 4 themes that we really like, where we have committed capital and we continue to see opportunities on a structural basis, is the AI theme. I mean, so we do continue to think that we think that this is going to be a structural theme upon us, so investors should take advantage of it, notwithstanding the volatility that could happen intermittently. The second that we like, given the regulatory backdrop of the current Trump administration that's likely to be that'll be inaugurated, is in biotech. So we continue to see pretty attractive opportunities in the biotech arena, in the drug discovery arena. So that is an area that has started doing well, and we continue to see opportunities there. And the third opportunity is in merger arbitrage. So as the administration and Trump has clearly said that we need to be more towards deregulation. So that means there's going to be more, takeouts, mergers and acquisitions, and merger arbitrage as an investment strategy, I think, after M&A winter is likely to take off. And then we look for opportunities, pockets of opportunities in places like Latin America, which are kind of orphaned at the moment. And investors, to the point, nobody is talking about it. And we see some very attractive value, and again, on a spread basis, on a long-short basis, in those types of strategies. So.
Yeah, and we'll get back to that geographic versus asset allocation as well afterwards, because that's quite an interesting dynamic. Hashim, I feel like I'm going to ask you an unfair question here. Obviously, I want your outlook, but I'm thinking on the one hand, inflation, people are worried about inflation. On the other hand, we've got perhaps a reduction, because of tariffs, a reduction in global trade. Counterbalancing each other, or not really?
Thank you for inviting us to this panel to speak. So,
Your mic's
okay.
Yeah.
I think, perhaps before addressing this, one should really understand what does it mean to own all of these assets. People talk about alternatives. I mean, at the end of the day, alternatives, whether they're liquid or semi-liquid, have an exposure to an economy. So you're still operating within an economy. So people need to understand that if they're moving to alternatives or they're taking illiquidity, what kind of economic exposure they're taking. And so to your question, whether these companies are able to deal with inflation or pass through the inflation so that the cash flow would benefit or not. And my sense is, a lot of the institutions, whether in the private side or even the long-term ones, are not looking at that aspect in thinking through what would it mean, because the inflation period has been very small. We've had this inflation up move and then it went away. So the basics of investing, people need to go to it and really think through. A private equity is owning a company. A public equity is owning a company. What does it mean to lock up your money for, Dave talked about 10 to 15 years. Of course, you need that type of period to do your work, but then the investor has to appreciate that. So I think in today's unknowns, people should really be open to different paths for their cash flow. This idea, that everything just runs as the spreadsheet shows is not real life.
Yeah, and I want a couple of you to build on that. And maybe, Diana, if you've got something to say on this, because obviously we're talking about the evolution of asset classes. We know what that means, outside of equity and all the rest of it. But actually the evolution within asset classes as well. So things, that were liquid investments before, people seeing increased liquidity there and more interest in evergreen semi-liquid products and things like that. Are you excited about that sort of expansion of alternatives in these specific areas?
Definitely. Again, I think I'll build on what my colleagues here on the panel actually are talking about. As we see more and more private assets and private companies being taken private, and the private assets in general is much more larger than the public assets so far. We definitely want to see more innovation on that front. So we're seeing, for example, now a lot of the private credit funds partnering with asset managers to create some kind of products with liquidity, ETFs that basically gives you a sense of exposure to the underlying illiquid nature of the private credit, for example, and that's definitely exciting. Again, one of the things that we definitely want is to have some liquidity, especially when that asset is continue to grow. And again, I completely agree. There's a lot of opportunities in that asset class, depending where you invest, whether it's in a private credit with an underlying real estate exposure, or a private credit with the loans, again. Mid-cap exposures, for example. Having that sense of liquidity or partial liquidity is definitely helps, especially when you're a large institutional investor and asset allocator. You want to build a barbell portfolio where you can actually manage the liquidity as efficiently as possible.
Yeah, I mean, liquidity never goes out of fashion, right?
No.
It's liquidity is king, and it always will be. David, since you've been in this space for such a long time, as you said, focused, same sort of question that I said to Diane there, is that, this evolution of assets within the alternatives. What are you seeing from all the way in sunny California?
Well, again, you can separate the venture capital world and the private equity world. The backdrop is, if you look around the world, US, European, global, 90% of the businesses, normal businesses, not tech businesses, are private businesses. When you read the papers, you think about, you hear of an overhang of capital seeking returns in privates. But the reality is there's enormous amounts of capital in the public markets seeking a financial return, and relatively little. So it's a bit, and the smaller you get, the much less efficient it is. So a lot of this approach to investing on the private equity front is playing that arbitrage of smaller companies, inefficient processes, and so forth. In venture is a tiny little part of the world. It gets a lot of play in the papers. It's intriguing when you see huge outcomes. But the reality is it's very risky, and these portfolios that are assembled rely on a few companies to have, a few companies out of 50 that will make for a great result. And even the most brilliant venture capitalists don't know which 3 are going to do it for them. It really takes 8 or 10 years to see what plays out. And so that's kind of the world that we live in.
And Phil, insurance capital going to private credit as well. Talk us some more through that and that liability mindset.
Sure. So, private credit is such a broad arena. It's almost like describing food. You think about the size of the debt markets and how much of it's private. I think what's changed is the proportion of that private credit market that's being provided by banks that is now constrained because of the regulatory environment. And that's created a broadening of private credit. Insurers, we have many insurer clients where that's become an engine in terms of where they're allocating. And I think it's the breadth of capabilities, whether it's direct lending, commercial mortgage loans that are private in nature, asset-backed finance has had quite an expansion. And I think this arena will grow, especially as additional types of investors, high net worth as an example, go into private credit. That could help with the liquidity that you referenced. But I think there is a landscape in front of us in which the private credit growth will continue. But I think there is a differentiation and risk management that's critical to get that right.
Absolutely. I just wanted to, we've only got 4 minutes left, but Shiv, and I wanted to bring you in on this, and Hashim as well, is that it's kind of happened to a certain extent, but this geographical investment being trumped by sectorial and thematic investments globally. Is that something that you're seeing a lot or advocating a lot in the assets that you allocate?
Yeah, I mean, for me, you always need to be geographically diversified. Theme investing is dangerous. So like, who would have thought that the AI would show up and then challenge all type of business models? So no, we don't advocate that. I think, geographic diversification is now a reality for a lot of people. That's why you have people showing up here, opening offices here. And I think, the theme investing, yes, you have to look for the new opportunities and think it through, but you're not gonna just suddenly say, oh, you know what, everything I wanna do is AI. Maybe, it turns out that all that CapEx takes longer to produce its results.
If you look at our portfolio, what we are trying to do is have individual positions that are sort of less correlated to each other, and building a diversified portfolio that gives you a higher Sharpe because of the lower pairwise correlation. So as part of that, I mean, we do have thematic positions, but it's also, to Hashim's point, I think it's important to caveat that, in that for us, we are in the public markets, and we play both from the long and the short side. And a lot of our managers are playing the spread within a team because of the greater inefficiencies between the winners and the losers, and they have a deep domain expertise in that arena. Compared to David, who takes a 15-year view, we are probably on the other end of that spectrum for what I do. And as a result, we can take advantage of opportunities because liquidity is one of the key tenets under which we operate. And ultimately, it's a case of asset allocation, because you do want to have your best of breed, venture capitalists in your portfolio, because there will be a time in the sun if you get out of the game. I mean, you can't get back in. So it is about asset allocation and diversification. And as I told you, some of the themes, we do see some favorable backdrop and tailwinds, and we do take advantage of managers, but who have an absolute return orientation, who just don't play the themes blindly. If that makes sense.
So Dan, we have 1 minute left. Since we're in Abu Dhabi, I'm going to end with you. No particular preference, but I just wanted to talk about the challenges out there. We kind of alluded to some of them as well. When we're looking at the market, what should people, when they're allocating those assets, be wary of? I mean, there's quite a few things that we've mentioned, but anything to add to that?
I think I think I do share a lot of the views here, especially when it comes to asset allocation. Definitely geographical allocation is important. If you miss the rally in the US, I think I'm too sorry for you, because that's very important. The top-down view is very important. But given the cyclical nature and some structural changes, it's very important to assess them very, very carefully. It's very important to really understand the value traps that could exist in these opportunities and themes. So I think the due diligence and the importance to capture these, let's say, cyclical or structural shifts we're seeing is very important, especially if you're going to play a thematic angle. We do that, so we already have a good understanding of certain themes, and we try to capture them. But again, I think it's very important to have the right teams, boots on the ground, really make sure you flip every rock to ensure that basically you don't fall into this value trap.
So good old-fashioned due diligence never goes
Always
out
important,
of fashion.
always
I'm an
important.
equity analyst, so I'm bound to say that on site. But anyway, gentlemen, thank you so much. That has given us a really good sort of look around the globe, and also dive down and deeper into some of these key things that people need to consider when they're allocating in these markets. So thank you so much for your time today. Very much appreciated. Thank you.